Did you know that in 1971, the U.S. unilaterally ended the dollar's direct link to gold, shattering a system that had stabilized global finance for decades? This single decision fundamentally shifted how the dollar and indeed the world operates financially. In this video, we'll explore the historical cycles of dollar strength and weakness and how events like the Bretton Woods breakdown directly impacted your investments. We'll break down complex ideas like currency pegs and quantitative easing into plain English, using relatable examples. If you find this clear explanation helpful, consider subscribing for weekly breakdowns of financial news. And let us know in the comments, what's your biggest question about the dollar's value? Now let's dive into how this pivotal moment in 1971 set the stage for the dollar's journey. Before this, the Bretton Woods system kept exchange rates relatively fixed, much like a price tag on a product. The dollar was king, directly convertible to gold at a set rate. Think of it as the world agreeing on a universal currency standard. But when President Nixon made that announcement, it was like the store suddenly removed all the price tags. The dollar became free-floating, its value now determined by market forces, supply, and demand. This paved the way for periods of both significant dollar strength and periods of notable weakness, directly affecting everything from your vacation plans to the price of imported goods. This is educational content, not financial advice. Did you know that in 1971, the United States unilaterally ended the dollar's convertibility to gold, a move that fundamentally reshaped global currency markets? This pivotal moment marked the beginning of a new era for the dollar, one characterized by constant fluctuations rather than a fixed exchange rate. Throughout history, the dollar has experienced periods of significant strength and weakness. Consider the 1980s, when a strong dollar made imports cheaper for Americans but made U.S. exports more expensive for the rest of the world. Conversely, a weaker dollar can make foreign travel more affordable for U.S. residents, while simultaneously boosting demand for American-made goods abroad. These swings aren't random. They're often driven by complex global economic and political forces. For instance, when the U.S. economy is robust and interest rates are rising, the dollar tends to strengthen as foreign investors seek higher returns. Think of it like a popular store attracting more shoppers when it offers a great sale. Conversely, during times of economic uncertainty, or when the Federal Reserve implements policies like quantitative easing, essentially injecting money into the economy to stimulate growth, the dollar can weaken. This happened significantly following the 2008 financial crisis, as reported by the Federal Reserve Bank of St. Louis, where the dollar's value saw a notable decline. Understanding these patterns helps in navigating investment strategies, as evidenced by research from organizations like the International Monetary Fund on currency volatility. Did you know that in 1971, the U.S. dollar experienced a significant shift when President Nixon ended the dollar's convertibility to gold? This move, known as the Nixon shock, fundamentally altered the global monetary system. The Federal Reserve, often called the Fed, plays a crucial role in managing the U.S. dollar's value through monetary policy. Think of the Fed as holding a baton, conducting the orchestra of the economy. One of its primary tools is setting interest rates. When the Fed raises interest rates, it makes holding dollars more attractive for investors worldwide. This is because they can earn a higher return on their U.S. dollar-denominated investments. Consider it like a sale at a popular store. When prices are higher, more people want to buy. Similarly, when interest rates are higher, global investors are more inclined to buy dollars to take advantage of those better returns. This increased demand can lead to a stronger dollar relative to other currencies. Conversely, when interest rates are lowered, holding dollars becomes less appealing, potentially weakening the dollar. The Fed also uses tools like quantitative easing, which involves injecting money into the financial system. This can increase the money supply, and if not managed carefully, might also put downward pressure on the dollar's value. This dance of interest rates and money supply directly impacts how much a U.S. dollar can buy on the global market, influencing everything from the cost of imported goods to the returns on international investments for individuals. Did you know that in 1971, the United States unilaterally ended the dollar's convertibility to gold, a move that fundamentally reshaped global finance? This historical pivot highlights how geopolitical decisions can dramatically influence a currency's standing. Periods of international uncertainty, like trade disputes or regional conflicts, often trigger a, quote, flight to safety. When global markets become volatile, investors tend to seek out assets perceived as stable and reliable. Historically, U.S. Treasury bonds, denominated in dollars, have served this purpose. This increased demand for dollar-denominated assets, in turn, strengthens the dollar's value on the foreign exchange market. Consider it like a crowded theater. When a fire alarm sounds, everyone rushes for the main exit, making that exit temporarily more valuable. Furthermore, the dollar's role as the world's primary reserve currency means it's used in a vast majority of international transactions, from oil sales to global trade. This constant global demand provides a baseline support for the dollar, even amidst domestic economic fluctuations. For instance, the Bank for International Settlements reported in 2022 that the dollar remained the dominant currency in foreign exchange markets, involved in 88% of all trades. This widespread usage creates a powerful network effect, reinforcing its global status. Did you know that in 1971, the U.S. dollar underwent a significant devaluation when President Nixon ended the dollar's convertibility to gold, a period often referred to as the Nixon shock? When the U.S. dollar strengthens relative to other currencies, it can create a dual effect for investors. On one hand, it makes foreign assets like stocks or bonds issued in euros or yen cheaper to acquire. Imagine buying a European vacation with fewer dollars than before. It's a similar principle for investments. However, this strength also means that the dollar-denominated returns from those overseas holdings can be reduced when converted back to U.S. dollars. For instance, if a foreign company's stock increases by 10% in its local currency, but the dollar has strengthened by 5% against that currency, the actual return in U.S. dollars would be closer to 5%. Consider this. A strong dollar can make imported goods less expensive for consumers, but it makes American exports pricier for international buyers. How might this shift impact a company's earnings? This dynamic underscores the importance of portfolio diversification. Rebalancing, or adjusting the allocation of assets, becomes a key strategy. It allows for capitalizing on cheaper foreign assets or mitigating the reduced returns from existing overseas investments. A well-diversified portfolio, spread across different asset classes and geographic regions, can help smooth out these currency-driven fluctuations over the long term. Did you know that in 1971, the U.S. unilaterally ended the dollar's convertibility to gold, a move that dramatically reshaped global currency markets? This historical event underscores how deeply intertwined a nation's currency value is with its economic and geopolitical standing. When the U.S. dollar strengthens, it means that for every dollar, one can purchase more of another currency. This has a direct impact on trade. For instance, imported goods become cheaper for American consumers and businesses. Think of it like a sale. A car manufactured in Japan that previously cost 3 million yen might now cost fewer dollars if the dollar has appreciated against the yen. Conversely, U.S. exports become more expensive for foreign buyers. That same car manufactured in the U.S. would now require more yen to purchase, potentially dampening international demand. What does this mean for the average person planning a vacation? A stronger dollar effectively stretches a travel budget further when visiting countries with weaker currencies. A hotel stay in Europe that once cost $200 might now be achievable for $180, all other factors remaining equal. This phenomenon can significantly influence consumer spending patterns and the profitability of import-export businesses. Understanding these dynamics is key to navigating the global economy. Did you know that during the early 1980s, the U.S. dollar experienced a period of significant strength, leading to challenges for American exporters? Now let's consider what happens when the dollar weakens. This shift can present intriguing opportunities for investors. When the dollar's value declines against other currencies, foreign assets effectively become cheaper for American buyers. Imagine a favorite European souvenir. With a weaker dollar, that same souvenir might cost fewer dollars than before. This can make international stocks and bonds more appealing, potentially leading to increased demand and value for those assets. Conversely, a weaker dollar can enhance the attractiveness of domestic assets to foreign investors. Think of it like a sale. U.S. companies and real estate become more affordable for those holding stronger foreign currencies. This can boost the prices of U.S. stocks and other domestic investments as global capital seeks value. However, navigating these currency fluctuations requires a thoughtful approach. The Federal Reserve's monetary policies, such as quantitative easing, essentially injecting money into the economy, can influence dollar strength. Understanding these dynamics, even at a high level, helps investors make more informed decisions. Ultimately, a long-term perspective is key. While short-term currency movements can cause ripples, focusing on a diversified portfolio aligned with financial goals often proves to be the most resilient strategy. Did you know that in the early 1970s, the U.S. dollar experienced a significant crisis, leading to the eventual collapse of the Bretton Woods system? This historical event underscores how currency values can shift dramatically, impacting economies worldwide. When the U.S. dollar weakens relative to other currencies, it creates interesting dynamics for trade. Suddenly, American-made goods become more affordable for international buyers, making U.S. exports more attractive. Conversely, imported products become more expensive for consumers within the United States. This can provide a competitive edge to domestic industries, potentially leading to job growth and increased production. Consider it like a sale at a popular department store. When prices drop, more shoppers tend to visit. Similarly, a weaker dollar acts as a global sale on American products. Furthermore, a weaker dollar can significantly boost tourism. For travelers from countries with stronger currencies, visiting the United States becomes considerably more budget-friendly. Imagine the difference a 10% discount makes on a vacation. That's often the effect a weaker dollar can have for international tourists. This influx of visitors can be a boon for the hospitality and retail sectors. But what causes these shifts? Geopolitical events, interest rate changes, and even global economic sentiment all play a role. Understanding these forces, even at a basic level, helps in navigating the financial landscape. Did you know that in 1971 the U.S. dollar faced a significant crisis when President Nixon suspended its convertibility to gold, a move that reshaped global currency markets? This historical event highlights the complex nature of currency values. Currency pegging is a monetary policy where a country fixes its currency's exchange rate to another currency or a basket of currencies. Imagine a small shopkeeper deciding to price all their goods in the same currency as a large, stable supermarket chain. This makes transactions predictable and can attract more customers. For instance, countries like Singapore have historically pegged their currency, the Singapore dollar, to a basket of currencies managed by their monetary authority, aiming for gradual and predictable appreciation. But what happens when the anchor currency experiences its own fluctuations? If a country pegs its currency to, say, the US dollar, and the dollar weakens significantly, that country's currency will also weaken, potentially impacting its purchasing power. This is similar to the shopkeeper's prices becoming less competitive if the supermarket's pricing strategy changes unexpectedly. This strategy aims to provide stability and control inflation, much like setting a firm price avoids the sticker shock of constantly changing costs. However, it can also limit a country's ability to respond independently to economic shocks. For example, if a country needs to stimulate its economy, it might typically devalue its currency. But with a peg, this option is restricted. Did you know there was a period in the early 1980s when the US dollar was so strong it significantly impacted global trade and even led to calls for intervention? Governments, through their central banks, do indeed step into the foreign exchange market to manage their currency's value. This is known as direct intervention. Imagine a central bank wanting to weaken its currency to make its exports cheaper for other countries. It might achieve this by selling its own currency and buying foreign currencies, increasing the supply of its own on the market. Conversely, if a country wants to strengthen its currency, perhaps to combat inflation or attract foreign investment, its central bank could buy its own currency. A well-known example of this strategy was seen in the Plaza Accord of 1985, where major economies agreed to weaken the dollar against the Japanese yen and German mark. More recently, central banks have utilized tools like quantitative easing, essentially injecting money into the economy, which can indirectly influence currency values. For instance, the Federal Reserve's large-scale asset purchases after the 2008 financial crisis were seen by many as a way to manage the dollar's strength. Understanding these interventions helps make sense of currency fluctuations that can affect everything from the cost of imported goods to the value of international investments. Did you know that in the early 1970s, the US dollar faced a significant crisis when foreign governments began demanding gold for their dollar holdings? This event, known as the Nixon shock, ultimately led to the abandonment of the gold standard and paved the way for the dollar's current status. Today, the US dollar holds the esteemed position of the world's primary reserve currency. This means it's the go-to currency for most international trade transactions and is held in large quantities by central banks globally. Consider it the ultimate global handshake for commerce. What advantages does this status bring to the U.S. economy? For starters, it allows the U.S. to borrow money at lower interest rates. Think of it like having excellent credit. Lenders are more willing to offer favorable terms. Furthermore, it reduces transaction costs for American businesses involved in international trade. But has the dollar always been this dominant? Not exactly. Historically, currencies have cycled through periods of strength and weakness, influenced by geopolitical shifts and economic stability. For instance, after World War II, the Bretton Woods Agreement pegged many currencies to the dollar, which was itself pegged to gold. This reserve status isn't static, however. Factors like national debt levels and global economic policies can influence its value. A stronger dollar can make imports cheaper but exports more expensive, impacting businesses and the cost of international travel. Conversely, a weaker dollar can boost exports but increase the cost of imported goods. Navigating these cycles requires a long-term perspective for investment portfolios. Did you know that during the Asian financial crisis of 1997-98, a significant portion of the turmoil was exacerbated by the dollar's strength? This highlights how the U.S. dollar's value isn't just an American concern, it's a global linchpin. When the dollar strengthens significantly, it often creates a ripple effect, particularly felt in emerging markets and developing economies. Why is this so impactful? Many of these nations carry debt denominated in U.S. dollars. As the dollar appreciates, the burden of repaying that debt in their local currency becomes substantially heavier, akin to someone needing to earn twice as much to pay off the same loan. Consider countries that peg their currency to the dollar, meaning they fix their exchange rate. A strong dollar can make their exports suddenly much more expensive for international buyers, hurting sales and economic growth. Think of it like a small shop owner in a foreign country suddenly finding their prices have doubled overnight due to a currency shift. Furthermore, the global financial system is incredibly interconnected. Actions like quantitative easing, where a central bank injects money into the economy, can influence dollar supply and consequently its value. This can lead to capital flight from developing nations as investors seek safer havens, further destabilizing their economies. The International Monetary Fund has extensively documented these dynamics in various global economic outlook reports. Did you know that in the early 1970s, the U.S. dollar underwent a significant devaluation, leading to widespread economic adjustments? This historical event underscores a fundamental truth about currency. Its value is not static. It fluctuates based on a complex interplay of global economic forces, political stability, and monetary policy. Consider the dollar's value like the tide. Sometimes it's high, making imports cheaper and international travel more expensive for Americans. Other times it's low, which can boost exports and make visiting foreign countries a more budget-friendly adventure. This ebb and flow directly impacts investment portfolios. When the dollar weakens, for instance, investments held in other currencies can increase in value when converted back to dollars. This is where diversification becomes a crucial strategy. Holding assets in different countries and across various asset classes, like stocks, bonds, and real estate, can act as a buffer. Think of it like planting different types of crops. If one crop fails due to unforeseen weather, others can still thrive, ensuring a harvest. Similarly, if the U.S. dollar experiences a downturn, investments in, say, European stocks or Asian bonds might perform well, offsetting potential losses elsewhere. This is particularly relevant when considering currency pegs, where a country attempts to fix its currency's value to another, or quantitative easing, where a central bank injects money into the economy. These actions can create unexpected shifts. Therefore, a well-diversified portfolio, including international holdings, isn't just about chasing higher returns. It's about building resilience against the inevitable cycles of dollar strength and weakness, safeguarding long-term financial goals. Did you know that in 1971, the U.S. dollar experienced a significant crisis when President Nixon ended the dollar's convertibility to gold? This event, known as the Nixon shock, fundamentally altered the global financial landscape. For investors seeking to proactively manage currency risk, understanding strategies like currency hedging becomes essential. Imagine it like buying insurance for a trip abroad. If a traveler plans a vacation to Europe, they might exchange their dollars for euros in advance. If the dollar weakens significantly against the euro before their trip, their money won't go as far. Currency hedging aims to lock in an exchange rate, protecting against such unwelcome surprises. Another advanced tactic involves using exchange-traded funds, or ETFs, that track currency movements. These can offer a more accessible way to gain exposure to currency markets. Consider how a strong dollar can make imported goods cheaper, while a weak dollar can boost exports. This dynamic affects the profitability of businesses and the cost of international travel. For instance, a strong dollar means a U.S. traveler's money buys more in Japan, but Japanese goods become more expensive for American consumers. While concepts like currency pegging, where a country ties its currency's value to another, and quantitative easing, a central bank's tool to inject liquidity into the economy, can seem complex, their impact on currency value is undeniable. These global financial forces create cycles of dollar strength and weakness, influencing everything from personal investment portfolios to international trade. Did you know that in 1971, the U.S. dollar experienced a significant devaluation when President Nixon ended the dollar's convertibility to gold? This event, known as the Nixon shock, dramatically altered the global financial landscape. When a business imports goods, it often pays its suppliers in a foreign currency. If that currency strengthens relative to the dollar, the cost of those imports rises, impacting profit margins. Conversely, for exporters, a stronger dollar makes their products more expensive for foreign buyers, potentially reducing sales. Consider a scenario where a U.S. company agrees to buy 100,000 euros worth of machinery. If the dollar weakens from €1 $1.10 to €1 $1.20 before the payment is due, the cost in dollars increases by $10,000. This is why managing currency risk is crucial for international trade. One effective strategy is using forward contracts. This allows a business to lock in an exchange rate for a future transaction, providing certainty and predictability. It's like pre-ordering a meal at a fixed price, regardless of how ingredient costs might change later. Another approach is diversifying a customer base across different countries and currencies. This reduces reliance on any single market, spreading the risk. If one currency weakens significantly, strong performance in other markets can help offset those losses, much like diversifying an investment portfolio to avoid overexposure to a single stock. Did you know that during the early 1970s, a period of significant dollar weakness, many countries scrambled to find stable alternatives for international trade? This highlights how fluctuations in currency value have always posed challenges for businesses and individuals alike. When the dollar strengthens, imported goods become cheaper, which can benefit consumers but hurt American exporters as their products become more expensive abroad. Conversely, a weaker dollar makes imports pricier, potentially leading to inflation, but it can boost American exports by making them more attractive globally. This dynamic is akin to a seesaw, with the dollar's value constantly shifting its impact. Businesses often adapt by adjusting their pricing strategies. For instance, a company exporting goods might absorb some of the increased cost when the dollar weakens to maintain market share, or they might pass on the savings when the dollar strengthens. This requires careful analysis of market demand and competitor pricing. Supply chain optimization is another critical area. Companies might diversify their suppliers across different countries to mitigate risks associated with currency fluctuations. Imagine a bakery relying on flour from only one region. If that region's currency weakens significantly, the cost of flour could skyrocket, impacting the bakery's bottom line. Spreading suppliers geographically offers a buffer. Furthermore, understanding concepts like currency pegging, where a country fixes its currency's value to another, or quantitative easing, a central bank's tool to inject money into the economy, helps explain some of the forces influencing dollar strength. These are complex mechanisms, but their ultimate effect is on the purchasing power of money. For investors, a diversified portfolio across different asset classes and geographies can act as a hedge against dollar volatility. Thinking about this through a long-term lens, rather than reacting to short-term currency swings, is often the most prudent approach. Did you know that in the early 1970s, the U.S. dollar experienced a significant crisis, leading to the collapse of the Bretton Woods system? This historical event underscores a fundamental truth about currency. Its value is not static, but rather a dynamic reflection of global economic and political forces. Understanding these cycles is paramount for any investor. These fluctuations, often referred to as currency cycles, are as natural as the changing seasons. For instance, periods of strong dollar growth can make imports cheaper for American consumers, but conversely can make U.S. exports more expensive for international buyers. Conversely, a weaker dollar can boost export industries but lead to higher prices for imported goods. Consider the concept of currency pegging, where one country ties its currency's value to another, like the U.S. dollar. When a country pegs its currency, it aims for stability, but can become vulnerable if the pegged currency experiences significant swings. Similarly, actions like quantitative easing, where a central bank injects money into the economy, can influence currency strength. While intended to stimulate growth, it can also devalue the currency over time. The key takeaway for the average investor is to embrace patience and discipline. Market volatility is inevitable, but focusing on a long-term investment philosophy, typically 10 years or more, can help weather these inevitable storms. This approach allows investments to benefit from compounding growth, often outweighing short-term currency fluctuations. For example, a diversified portfolio, weighted towards assets that tend to perform well over extended periods, can provide a buffer against unpredictable currency shifts. Did you know that in the early 1970s, the Bretton Woods system collapsed, leading to significant volatility for the U.S. dollar? This historical event underscores the ever-changing landscape of global finance. Understanding how to stay informed about economic trends and geopolitical developments is crucial for navigating the dollar's influence. Consider it like keeping an eye on the weather forecast before planning a trip. Knowing what's coming helps in making better decisions. For instance, a sudden increase in global oil prices, often tied to geopolitical tensions, can directly impact inflation and, consequently, the dollar's purchasing power. When economic conditions shift, central banks might employ tools like quantitative easing, which is essentially injecting more money into the economy to stimulate growth, much like a baker adding more yeast to make dough rise faster. Alternatively, policies like currency pegging, where a country fixes its currency's value to another, can create stability but also limit flexibility. These actions, detailed by institutions like the International Monetary Fund, IMF, have ripple effects on investment portfolios. The key takeaway for individuals is the importance of continuous learning and adaptability. This means regularly reviewing financial news from reputable sources, understanding how global events might affect personal investments, and being prepared to adjust strategies. A long-term perspective, focusing on diversification and sound financial principles, helps mitigate risks during periods of dollar volatility, allowing for more confident financial planning.